and welcome. You're watching the Global Reset from the CNBC-TV18 Prime Ionic Wealth Studio with me, Surabhi Upadhyay. Joining me in just a bit from now today is Adrian Mowat, who is someone who's watched the emerging market landscape for many, many decades. And of course, he has a very keen eye on India as well. We will be discussing all things Fed, the outlook ahead, and what lies for the Indian equity markets ahead in 2026. But before we get to that, let's quickly bring you up to speed with the overnight action. And it was all about the U.S. Federal Reserve. Now, in a widely anticipated move, a divided Federal Reserve approved a third rate cut in the current year, fulfilling expectations of what was widely seen as a hawkish cut. The FOMC has lowered its key borrowing rate by a quarter percentage point, placing it in the 3.5% to 3.75% range. However, the move carried caution about where policies eventually headed here on and featured no votes from 3 Fed members, and that hasn't happened since September 2019. The split featured hawkish and dovish dissents. Governor Stephen Mirren favored a steeper 0.5 percentage point cut, while regional presidents Jeffrey Schmidt and Austin Goldsby backed holding rates in line. Remember, this was the third consecutive no vote from Mirren. In addition to the rate decision, the Fed also announced that it will resume buying U.S. treasuries. The central bank will start by buying $40 billion worth of treasury bills, and this starts on Friday. Reacting to this 25 basis points cut, stocks on Wall Street closed Wednesday higher. The Dow actually was up almost 500 points. The S&P 500 added about 50 points, and the tech-heavy NASDAQ also surged about 80 points. So all was well on Wall Street. That 25 basis points rate cut was delivered. However, markets in Asia started giving up early gains, and they were trading mixed. Back home, the Nifty has reclaimed the 25,800 mark, but questions remain on the domestic story here and, of course, the future of the India-US trade deal as well. And we'll get to all of that in just a moment. But first, let's start by putting the Fed action into perspective. Here's CNBC's Steve Leisman.
The Federal Reserve reducing interest rates by an expected quarter point to a new range of 3.5 to 3.75. There were 3 dissents. The first time that's happened since September 2019. 2 were against the cut, including Chicago Fed President Austin Goolsbee, along with Kansas City Fed President Jeff Schmidt, his second dissent in a row. Also, another dissent for a 50 basis point cut from new Fed governor on loan from the administration, Stephen Mirren. To recap, the vote was 9 for cutting a quarter, 2 against cutting, 1 for cutting 50 basis points. The Fed signaled a higher bar for the next cut, using language that it's used in the past to do so, saying that it will assess incoming data to determine the extent and timing of future rate moves. That language it used it last December to signal a pause. The rate outlook suggests consensus for just 1 more cut next year and 1 more in 2027. But as I'll get to when I talk about the dot plot, a lot of disagreement. Before the dot plot, though, I want to talk about some pretty big news when it comes to the balance sheet. The committee making a determination, it is now at what it calls an ample level of reserves. So it plans to initiate purchases of shorter-term treasuries on an ongoing basis. And then a separate document was specific, saying the Fed will begin buying $40 billion in bills starting December 12th. That's just a couple days from now. And I believe that's sooner than the market expected. And those purchases will go on for a little while at an elevated level because of seasonal demands for reserves that are out there before coming down again in April. That's what the document says. Outlook on the economy in the statement. GDP outlook was stronger next year in the Fed's own forecast, up 0.5 point to 2.4%. So pretty big move there in the outlook for GDP next year. The inflation outlook lower for next year by just a tick, down to 2.5%, just about hitting the target of 2.1 in 2027. The statement says the economy is expanding at a moderate pace. Job gains have slowed and unemployment has edged up. Just a note, the statement no longer says that the unemployment rate is low at the current rate. Inflation is seen as somewhat elevated. Economic uncertainty also elevated.
So economic uncertainty and inflation remains elevated. Let's actually listen into the Fed chair himself on the path of monetary policy ahead.
Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a quarter percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. The adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves. So it's really tariffs that's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry, about the labor market, because the labor market unemployment was very low. If you remember when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both. And I think we're doing the best we can for people.
All right, so that was the Fed chair describing what he sees ahead as he delivered that 25 basis points rate cut. Now, as promised, we have with us Adrian Mowat, investor, Hong Kong SAR. Adrian, of course, has been watching the global equity landscape for many, many years, for decades. Adrian, great to have you with us on the program today. So let's start with the US before we talk about Asia and India. And interestingly, despite all the turbulence and the tariff wars, for the better part of this year, the US economy found itself in a pretty sweet spot, as did the US market, and things have kind of rolled along quite nicely. How do you sum up, how the US and the US market, both the economy and the market, are positioned as we get set to wind up 2025?
I think the outcome for US economic growth is significantly better than was feared during Liberation Day, when the Trump administration announced all those very high tariffs. It is worth, though, looking at the details within the economy. So we've got very large capex, but focused within AI spend, data center spend. Capex more broadly looks quite weak in the US. Plus, the US housing market is also poor in terms of transaction volumes, and quite a lot of major cities, prices are coming off. We've had, because of the government shutdown, data around the labor market missing. We're now beginning to get that data coming through. And as you note on your Fed comments earlier, that the labor market is no longer seen as having low unemployment, and that we're beginning to see evidence that the robust job growth, which really characterized the US economy post-COVID, has coming to an end. So I see a market where we're responding to the AI spend, the capex that's going on there. But when we look at the broader market, look at some of the retailers that have sold off more recently because of poor numbers, that the US economy is not necessarily as strong as the current level of the S&P implies. So interesting, looking at the Fed decision, two Fed governors dissenting, believing that they shouldn't be cutting rates, another dissent for a bigger cut. I think it's a very, very hard environment for the Fed, where the headline inflation rate, the core inflation rate, is also above their target zone. So it's going to be very interesting moving into the first quarter of next year. And there is an expectation of a slight acceleration in growth as some of the household sectors begin to get a benefit from the tax cuts that were in the big, beautiful bill. But it's also possible that that acceleration doesn't occur because the slowing in momentum that's beginning to appear in some of the data may broaden within the economy. So moving into next year, my level of confidence on projecting what's going to happen in US economic growth is quite low.
Interesting, because this year was more or less steady despite all that turbulence. Adrian, also, what did you make of the Fed's move to start buying bonds again? They've started with $40 billion in Treasury bills. And interestingly, the market doesn't seem to be fussing too much over Fed independence. It seems to be perhaps, taking the next Fed chief, the fact that they'll probably be quite dovish in their tilt and toe the White House line. The market seems to be, making its peace with that. So what are your thoughts on these fronts?
So I think when you say the market's making its peace, you're referring to the fact that 10-year bond yields came off modestly overnight rather than perhaps rising because of fear of Fed independence being undermined. I'm very anxious about the US bond market. So 10-year yields are 4.12 at the moment. The upper end of the Fed band is 3.75. So there's almost no term premium. You're really not getting paid for taking on the duration risk at 10 years, you're getting paid a little bit more at 30. But remember, we're doing that when the fiscal deficit is rising into next year. Fiscal deficit is already extremely large in the US, as it is in many other developed countries. And I still see the bond market as probably the biggest source of potential volatility over the next 12 months. And it is possible that if the inflation data remains elevated, and if people's concerns over just how many bonds have to be issued begin to bear out in the market accepting a more reasonable term risk premium. I mean, just think about this as a number. The average yield curve prior to the global financial crisis was 1.75%, 175 basis points between 3-month money and 10-year money. That used to be the average. We are well away from that. So I think the context of the Fed ending quantitative tightening and perhaps announcing some flexibility around a bit of QE is them recognizing that there is significant risk from the bond market, that you do have a potential that the Fed is cutting and bond yields actually start to rise and could rise quite rapidly. We did have bond yields above 5% briefly in the last 2 years. That wouldn't be an unusually high level versus the historical context.
So interesting. You wouldn't be surprised if the US 10-year indeed starts heading higher once again at some point next year?
Yeah, so I go back to thinking about a world prior to the global financial crisis, prior to this period where we had zero interest rate policy and QE. And back in that world, if you exclude the periods of inversion and you looked at the average yield curves, the average difference between 3-month and 10-year rates, it came out at 1.75%. We're nowhere near that. It is perfectly reasonable for bond investors to be paid for taking duration risk. And at this point in time, they are not paid for taking duration risk. So let's say the Fed takes rates down to 3.5, having 5% long-term interest rates would be very normal in the pre-GFC world.
Yeah, and that's a world that we saw well over 2 decades back. So whether we move towards that normal or not, we will find out. We do have to take a break, Adrian. Stay on with us. But as we take this break, let's leave viewers with the latest comment that came in from the US president on the Fed chief. Now, he was speaking after the FOMC announcement, and he called the Fed chair a stiff and criticized the pace of interest rate cuts. Trump suggested that the Fed's rate reduction was far too modest and should have been doubled. Listen in. We'll take that break and come right back.
Interest rates are going down, except with him, not too much. He did a rather, I would say, a rather small number that could have been doubled, at least doubled. I've wanted to say it. I do say it. I believe it. And we have to get a mindset that when a country is doing well, you don't want to kill the growth. That's what they're doing. They kill the growth. I don't know if you guys even agree with that. They kill the growth because they're so afraid of inflation. But you can have tremendous growth without inflation. Everything goes up with the growth. But that's not inflation. So I think we can do much better than traditional numbers.
Welcome back. You're with us on the Global Reset, and we're in conversation with Adrian Mowat. Adrian, so now we've set the context with what's happening in the US and what the economy is doing over there. I want to come to India and Asia now, really, because it's been one of those years where Indian investors have had to keep a lot of patience, and they have watched the India underperformance. In a year when markets like South Korea have rallied 70%, we have a paltry, 6-7% on the index to speak of. Do you see that changing in 2026?
I don't see a short-term change to it. So we've got a number of factors at work here. We have an ongoing trade dispute between the US and India, and the rhetoric on that still seems to be pretty hot, with issues around rice more in the last week. So the risk is that the rupee, which has broken through 90, could continue to weaken, or certainly remain one of the weakest Asian or even EM currencies. Because of this trade dispute. I think the other factor to be aware of, you talk about the move in Korea. Well, Korea's been a big beneficiary of semis related to AI, plus some of the heavy industries in Korea are defense spending companies. So it's been sitting with a market that plays on some of the key themes. Unfortunately, the Indian market has a very low exposure to the AI story. And yes, I appreciate that you've got your TCSs and your emphasis, et cetera, but AI could be a bit of a double-edged sword in that AI does the programming, and maybe you need fewer Indian programmers working for those companies sitting in US businesses or supplying US businesses. So for now, I think, unfortunately, India's underperformance continues. And what we'd like to see is a reduction in the noise level around the trade dispute with the United States to allow the rupee to stabilize. Now, the bull case for India is, as people have discussed already, there is an acceleration in earnings growth going into next year. The market has derated a bit, although it could derate more, still being one of the more expensive EMs. So for now, I don't see a catalyst for a change in this underperformance.
Oh, okay. Well,
I just don't see what it is. Yeah.
You're calling it out as you see it. Absolutely, take that point. But I want to discuss this one by one, some of the factors that you laid out, starting with the trade deal that just didn't happen through the year, and we're almost rounding up 2025. In fact, allow me to bring in our colleague Abhimanyu into this as well. In fact, yesterday, the Indian Commerce Minister, Mr. Piyush Goyal, did make a comment on this. And he said that India cannot negotiate, with deadlines limiting those negotiations. Listen into those comments.
I've said many times that all agreements, all discussions have many different angles. Many dots have to be connected. And we never negotiate deals with deadlines. Thank you.
So that's what you heard. We also heard from the U.S. Trade Rep Jameson Greer yesterday. He was saying that, negotiations are tough, but they're ongoing. And there's a U.S. team that's been in New Delhi to take the negotiations forward. Now, where have things reached? Let's go across to our colleague Abhimanyu to find out. Abhimanyu, what is the latest?
Well, the negotiations are still underway. India and the US, both their teams are still talking in New Delhi. Now, this is not an official round of negotiations, not a formal round of negotiations, but all pending issues on the table are being discussed, all pending trade issues, including the issue of tariffs, which currently stand at 50%. Now, 50% tariffs also include 25% reciprocal tariffs. And despite the imposition of these tariffs in the first half of this financial year, there has been an uptick of 13.3% in India's exports to the United States. However, this also includes the time when tariffs were not levied. So, of course, post-levy of the tariffs, there have been concerns which have been increasing for several labor-intensive exporters, particularly in segments like leather and textiles. And many such exporters are already running thin as far as seeking opportunities in other countries is concerned. Now, speaking about other opportunities being looked at, they are trying to diversify into different markets, which cannot happen overnight. Meanwhile, the government is negotiating for the interests of not just these exporters, but also for the interests of farmers and fishermen across the country. And it has been repeatedly stated by the government at several levels that no interests are going to be compromised, particularly of farmers, fishermen, and even small traders for that matter. So speaking about market access, which the US is looking into the Indian market, these, of course, would be several issues which are going to be discussed. There are, of course, red lines, as earlier indicated too by the Commerce Minister. Meanwhile, India is also looking to diversify its oil import sources, which includes the possibility of increasing imports of crude oil and natural gas from the United States.
Yes.
So there have been such discussions also, which the Commerce Ministry has undertaken till now.
Absolutely. That's been India's stated promise that we will be increasing our energy imports from the US. But we need more clarity. Abhimanyu, behind you, I see a lovely, clear New Delhi day. But as far as those trade talks are concerned, we definitely need more clarity. Thank you for that. So, Adrian, I mean, to sum this up, and I take your point that the underperformance here could continue. FPIs have sold off almost $18 billion worth of Indian stocks here, right? But on the AI bit, now that's where we Indians are beginning to, notice global developments with a lot of caution. Overnight, we had the Oracle stock falling 10, 11%, right? Do you expect global investors will want to diversify a little away from AI, including all the Asia AI plays as well? And if that happens, could you see some tweaking of portfolios? Are you hearing any conversations saying, okay, let's allocate a bit more to India, it's underperformed, and we need to diversify?
I think we've got to remember the starting point here was India had been outperforming for a number of years, with particularly big markets like China and to some extent Korea not doing so well. So we're probably still in a process of people reallocating out of India into these other emerging markets. And the level of underperformance, year to date, is about 30% for MSCI India in US dollars versus the MSCI EM and the China index. So that's a big number, and a very painful number if you haven't got a proper underweight in India running a global EM portfolio. There is a chance that the AI story starts to lose some momentum and you get a more significant correction. And Oracle does have a very poor balance sheet, and you can see its credit default swaps beginning to reflect that. The underperformance of Oracle, particularly when it's announcing data center numbers that are a bit disappointing. But at the same time, we've had some very good news out of Alphabet or Google, where their chips are seen as potential competitors to NVIDIA. Their numbers are very strong. The share price sort of has hit 310, continuing to move higher. So I don't see the AI theme coming to an abrupt end. Definitely at individual levels, there are stocks where they're maybe overvalued, not pricing in some of the balance sheet risk. But Oracle is kind of the exception there. Most of the other balance sheets of these Mag 7s are very, very healthy. So for now, I think you have to keep on running the AI theme. And the chip stocks, the semiconductor stocks in Korea are actually very cheap on P multiple basis, on price to book basis. Now you could say, well, that's top of the cycle, but they are inexpensive. And even a TSMC, which has basically the monopoly on high-end chips, is probably fair value at these levels.
So hearing you, I don't get the sense that anyone's getting out of the AI plays out of Asia anytime in a hurry. So I think we'll just have to wait, and maybe the reset for India will have to happen in the form of that trade deal and better earnings here. And that's the hope with which we enter 2026. Adrian, it's been a great conversation. Thank you so much for taking out the time. Pleasure having you on the show today. Thank you.
Thank you.
All right, with that, we are out of time on this edition of the show. Many thanks for watching. We'll see you again tomorrow.